Vistra Corp is currently trading at 159.21 USD, reflecting a sharp intraday drop of 14.24 points, or about 8.21% today, December 18, 2025. While the initial reaction to such a significant slide is often one of concern, there is a much deeper layer to this movement that most retail investors are completely overlooking right now. The expectation in the market has been that the high-flying utility sector would continue its climb without resistance, fueled by the insatiable demand for electricity from data centers. However, the reality of today's price action reveals a cooling of that overheated sentiment, triggered by a combination of technical resistance and specific insider activity that signaled a localized top. While many are panic selling because of the red on the screen, a sophisticated observer of Vistra stock would notice that this pullback is occurring on volume that suggests institutional profit-taking rather than a fundamental breakdown of the business. Just last week, SEC filings showed the CEO of Vistra, Jim Burke, executed a pre-planned stock sale under a Rule 10b-5-1 plan. While these sales are often automated and scheduled months in advance, the optics of a CEO selling millions of dollars worth of stock as the price approaches all-time highs often triggers a domino effect among algorithmic trading platforms. This creates a fascinating tension between the long-term growth story of nuclear power and the short-term reality of market mechanics. If you are using platforms like Fidelity or looking at your individual brokerage account today, you might be seeing similar volatility across other names in the power sector. This is not just a Vistra problem. It is a sector-wide realization that the transition to a high-demand economy takes longer than a single fiscal quarter. When you invest online, it is easy to get caught up in the momentum, but the smart money is looking at the 20-year power purchase agreement Vistra recently signed for its Comanche Peak nuclear plant. That deal provides a massive baseline of stability that today's price drop completely ignores. The current market narrative is heavily weighted toward how AI will require massive amounts of baseload power, and Vistra has been a poster child for this theme. Because Vistra operates one of the largest competitive power generation fleets in the country, it sits in a unique position. Unlike regulated utilities that have a capped return on equity, Vistra can sell its power at market rates, which means when demand spikes, their margins can expand dramatically. This is why the stock has been such a powerhouse over the last year, often outperforming even Nvidia stock or Apple stock in terms of percentage gains during certain windows. However, the reality we are seeing today is that the market had priced in perfection. When JP Morgan recently lowered its price target on Vistra from $249 to $233, it served as a wake-up call. Even though $233 is still significantly higher than the current price of $159.21, the downward revision of the target price created a vacuum. Investors using tools like Schwab Intelligent Portfolios or other automated investing sites often see these shifts as triggers to rebalance. This contributes to the downward pressure we are seeing in the live session. For those of you who manage your own portfolios through a Robinhood app or a SoFi trading platform, it is vital to understand the difference between a company whose business is failing and a stock that is simply undergoing a healthy correction. Vistra is still generating incredible amounts of free cash flow. In their most recent reports, they even narrowed their guidance to the higher end of their previous range, which shows that management is confident in the operational side of things. The disconnect today is purely a valuation reset. The rise of online investing has made it easier than ever for retail traders to jump into complex sectors like independent power producers. But with that ease comes the risk of not understanding the underlying mechanics of the energy grid. Vistra isn't just a nuclear company. They recently acquired 7 natural gas plants to diversify their fleet. This is a tactical move to ensure they have the capacity to provide dispatchable power when the sun isn't shining or the wind isn't blowing, which is a major concern for the big tech companies building out data centers in Texas and the Northeast. We are seeing a lot of activity in the options market today for Vistra, with a high volume of put options being traded as people hedge their positions. This kind of activity is often what you see on an interactive brokers platform when professional traders are trying to protect their gains. If you are looking for investment help, the first thing to realize is that volatility is the price you pay for the outsized returns Vistra has provided. You cannot have the 120% gains without the occasional 8% drawdown. Comment below how many shares of Vistra Corp you currently hold, or if you are planning to buy this dip. It is always interesting to see how the community is positioned during these volatile sessions. Looking at the broader macro picture, the interest rate environment is also playing a role here. Utilities are often seen as a proxy for bonds because of their dividends, but Vistra is different. They are a growth-oriented energy company that uses its cash flow to buy back shares aggressively. This means that every time the stock price drops like it is doing today, the company can effectively buy back more shares with the same amount of capital, which is a massive long-term tailwind for remaining shareholders. The expectation was that the government's push for a nuclear renaissance would be a smooth, upward line. The reality is that building new reactors or even extending the life of old ones is a bureaucratic and logistical challenge. When reports came out recently suggesting that the timeline for new nuclear projects might be longer than the hype suggested, it took some of the wind out of the sails for Vistra and its peers like Constellation Energy. But again, Vistra's existing fleet is already operational and already minting money, or rather generating substantial cash. If you are using a Fidelity mobile app or checking your Interactive Brokers account, you might notice that Vistra's technicals are currently testing their 50-day moving average. For many traders, this is a make or break level. If the stock can hold this 159 level and bounce, it confirms that the long-term uptrend is still intact. If it breaks below, we might see a more prolonged period of consolidation. This is where self-investing becomes a test of conviction. Are you here for the daily fluctuations, or are you here for the decade-long transition to a high-energy demand economy? Vistra's business model is built on 3 pillars: retail, generation, and optimization. Their retail arm, which includes brands like TXU Energy, provides a stable, recurring revenue stream that helps buffer the volatility of the wholesale power markets. Their generation fleet is one of the most diverse in the country, and their optimization team is world-class at hedging their output to lock in prices years in advance. This is why they were able to report a net income of $652 million in the third quarter, despite some operational challenges at one of their Texas units. Many people compare Vistra to Tesla stock because of the disruptor narrative. While Vistra is an old-school industrial company in many ways, their approach to the energy transition is definitely disruptive. They are moving faster than almost any other utility to position themselves for a world where electricity is the primary fuel for everything from transportation to artificial intelligence. This is why you see so much institutional interest, with over 90% of the stock held by big firms. When these firms decide to trim their positions at the end of a year like 2025, it creates the kind of volatility we are seeing today. When you look at investing sites or use a SoFi robo-advisor, you are often looking at trailing data, but the stock market is forward-looking. The market is currently trying to figure out what Vistra's earnings will look like in 2026 and 2027. Management has already initiated guidance in 2026 that shows significant growth in EBITDA and free cash flow. The reality is that the company is getting more efficient and their assets are becoming more valuable as the grid becomes more strained. The institutional activity in Vistra has been intense. We've seen major firms like Lone Pine Capital and State Street increasing their stakes significantly over the past few quarters. This tells you that the people with the most resources and the best data are still bullish on the long-term prospects of Vistra. They aren't worried about an 8% drop on a Thursday in December. They are looking at the multi-year trajectory of power prices in the ERCOT and PJM markets. If you are using a Robinhood trading platform, it's easy to get distracted by the top losers list where Vistra might appear today. But remember that the best investments often look the scariest when they are on sale. The tension between the expectation of a straight line up and the reality of a jagged path is what creates opportunity. Vistra's recent acquisition of natural gas plants from Lotus Infrastructure Partners is a perfect example of their strategic strategy. They bought those assets to ensure they have the capacity to meet the growing needs of the Permian Basin, which is seeing a massive surge of electricity demand from the oil and gas industry as it electrifies its operations. The future outlook for Vistra is a complex mix of regulatory